Good morning or good afternoon, guys, wherever you're from. Happy New Year. Let's get this party started. Hope everyone had a safe and happy holiday, happy New Year's. We're rocking and rolling over here at Directed IRA, back in the office. We're excited to share some more education with you guys for the new year. Maybe even tell you about some things that are coming up as far as Directed IRA goes. But just give you guys an opportunity to kind of just kickstart the year off right. And we're going to start talking about buying real estate inside retirement plans. We're going to answer some questions, make this really interactive as we can. And this will be really good, whether you're new or experienced. It's always good to kind of recap, how it works to buy real estate inside of a retirement plan. Why would you want to do such a thing? What are some of the misconceptions people have with doing this type of investing when you're investing in things outside of the stock market? But it also gives us an opportunity to network a little bit with one another. So I always encourage anybody who's on, this is a public forum. So this is twofold for us, really. One, it's to provide education not only to clients but non-clients alike on what you can really do with a retirement plan, especially when you self-direct it. But it's also a platform where you can network. Uh, our clients are always looking or on the lookout for new investments. So if you're a client of ours and you don't have an investment, well, maybe you'll meet somebody, through the workshops or through the webinars, through the chat. So just be careful. Obviously, we don't endorse or promote any products or services or any investments. So anybody that's on here selling investment, that's fine. But just beware, we're not promoting any investments. We're not putting this out there to do that. So always do your due diligence. But we're excited to have you guys on for our first workshop of the new year. So I think we've got enough people on to get started. Let me get my chat. Sorry, give me 1 second here. Sorry, I always do this, guys. Get my chat enabled. Thank you for the reminder. Let's see. Cass, if you can help me too with the chat, getting it enabled. I know that there's a button on here somewhere. Angel usually does it for me.
Yes, let me look into that.
Okay. Yeah, we'll get the chat here enabled here in a second. But that's also a good reminder. If you guys have questions, type the questions into the Q&A section. And keep the chat within each other. So Cassandra's on here. She's going to let me know if there's any good questions on the Q&A part to stop and answer the questions as is. I'm also going to have Darren. Darren's one of our account specialists. He's been in the business for almost a decade. And he's on here as well to help answer questions as we go. So you'll have several people on the chat monitoring to answer questions, and then I'll answer questions at the end as well. So let's just jump right into it. And Cass, just let us know when you get that chat enabled. But I'm going to jump into this and start sharing my screen. All right, so let me know if you guys can see that okay. We're going to talk about buying and selling real estate inside not only an IRA, but an old 401k, an old 403b, health savings plan, an education savings plan for your kids. There's really a lot of different plans that you can use to buy and sell not only stock, but buy and sell alternative investments like real estate. Real estate's kind of one of the catch-alls. We have a lot of clients that are interested in buying real estate inside retirement plans, but they don't know how it works. They've gotten some misconceptions from their wealth advisors. You get a lot of misconceptions, bad information from wealth advisors or people that are selling investments, because obviously they have a vested interest to see you not invest in things outside of the stock market. So we're going to touch on a little bit of that. And then I have some client case studies to kind of wrap everything together and give you kind of a foundation of how the process works when you want to take an IRA, an old 401k, health savings account, or any tax exempt savings plan you have and buy real estate. What's the process like? Because there's a couple different ways you can do it. And we'll talk a little bit about that as we go along. My name is Nate Hare. If you guys are not familiar with me or Directed IRA, Directed IRA is a licensed and bonded trust company here in the state of Arizona. We manage retirement accounts for the purpose of buying alternative investments. We're not licensed securities brokers, though. We don't sell investments to our clients. When you have a retirement account with Directed IRA, you have the keys in your hand. You tell us what you want us to invest in, and that spectrum of investment goes way outside your traditional stocks, bonds, mutual funds, and CDs. What we're not allowed to do, since we're self-directed custodian, is we can't give you tax, legal, or investment advice. So even though I've been an investor since 2002, you'll find a lot of our principals are investors. Aaron Holderman, our COO, has been in the note space for many, many years. A lot of you guys might have met him at some note conferences that he used to host. Matt Sorensen's our CEO. He's also an investor. Even though we're investors, we can't give you guys tax, legal, or investment advice through Directed IRA, but we can provide you guys a lot of education. And that's the purpose of these workshops and webinars that we do are guided to do, is to just give you good education. Just a little background on me, how I stumbled into self-directed IRAs. Well, first of all, I didn't even know what a self-directed IRA is, barely what an IRA was when I was in the traditional, I would say, in the box corporate world of real estate. Right out of college, I got into real estate, always knew I wanted to be a real estate investor of some kind. Went to real estate school. I had my real estate license with Keller Williams. Spent most of my career as a residential loan officer, though. That's where I kind of got my background on real estate. I still hold my loan officer's license, even though I don't use it actively. But that's kind of where I started in real estate, was through the financing side of real estate, in the traditional way of financing real estate. Well, in 2012, I was recruited by a self-directed IRA company, and I had no idea even what a self-directed IRA was. But as soon as I learned about what a self-directed IRA was, and it was really just the ability to take my retirement plans and invest it in things that I knew and understood, which at the time was real estate and lending. And I learned that I could actually use my retirement account to invest in that versus the stocks that I was buying and selling currently. My mind was blown because I thought, how is this legal, and why is this the first time I'm hearing about this? And I really got passionate about teaching this to other people, because this is not information that you learn in school. You're not going to learn it in high school. You're not going to learn it in college. You're not going to learn it post college. You really have to stumble on this information and education through workshops like this, or through working through a self-directed IRA company. So ever since I started working, yep, go ahead, Cass.
Sorry, not to cut you off. I have to walk you through. I don't have the proper setting to turn on the chat. So I just want to walk you through it before we get much further.
Yep, go ahead.
So in the webinar chat on the right-hand side, you should see the paper, smiley face, and those three dots.
Yeah.
Click on those three dots, and then it should have a setting in there to enable the chat.
I don't see chat, show chat previews. Captions, polls, pause recording, disable. I don't see. Sorry, I just don't see.
No, it's okay. I just called Tristan because mine's grayed out.
Okay, video settings. Yeah, we'll figure it out here in a sec. Sorry, guys. Just if you've got comments, though, just put them in the Q&A section for now. We'll get this thing worked out. But anyways, back to the presentation, or back to the workshop. I have become passionate about teaching this to other people because I wish I would have known it 10 years prior to me knowing it. And again, you're not going to learn this, and you're definitely not going to hear this from any wealth advisor that's selling you stocks or bonds or mutual funds. No offense to stocks and bonds, but obviously they have a vested interest to see you invest in those types of things. So why is it important to even talk about retirement plans when we're talking about buying real estate? Well, really, it's just important to talk about retirement plans regardless of what you're investing in, because it's the largest source of Americans' wealth. There's well over $30 trillion in retirement plans that consist of 401ks, 403bs, TRS, 457 plans, IRAs. It's the largest source of Americans' wealth. More people have money in their retirement plans than they do in their bank accounts. That's no mystery. But when you look at the retirement plans, all $30 trillion of it, very little of it is invested in what we call alternative investments. Alternative investments are really just anything outside of Wall Street. Okay? Anything outside of Wall Street would be considered, alternative investments. When you look here, these are the investments you can own inside of a retirement plan. But it doesn't stop here. The IRS actually in the code does not tell us what we're allowed to invest in with our IRAs or 401ks or 403bs. They only tell us we can't invest in two things when it comes to your retirement plan. The only two things your retirement plan cannot own are life insurance contracts and collectibles. That's it. So if anybody, any wealth advisor, any smarty pants person is telling you, no, you cannot buy real estate in an IRA, fire them and find somebody that even understands the rules. Or they might have a vested interest to see you invest in the things on the left, which are the stocks, bonds, mutual funds, ETFs, REITs, and CDs. No offense, or I have nothing against those investments, but those are what 98% of Americans have in their retirement plan. Not because they understand those investments, but that's all they think they can invest in. Because when you have an IRA at Fidelity or you have an IRA at Charles Schwab, they're only going to hold what they sell. That's just the nature of the business. They're licensed securities brokers and they sell investments. When you have an IRA at Directed IRA, where we don't have investments to sell you, our account agreement simply reads, invest in anything the IRS allows, but you have to tell us what that investment is. So it goes well beyond stocks, bonds, and mutual funds. You can actually invest in stocks, bonds, and mutual funds in an IRA, Directed IRA, but you can also invest in things like rentals, fix and flips, commercial property, multifamily, private equity, private stocks, syndications, promissory notes, cryptocurrency. I mean, the list goes on and on. Again, as a reminder, the only two things you can't own are life insurance contracts and collectibles. So, as a general rule of thumb, when it comes to your retirement plan can own anything you can hold title to. Okay? It can own a car, it can own a house, it can own land. Okay. Now, obviously, real estate and land is somewhat of a better investment, I would say, than a car. But anything you can draw up a purchase contract to buy and anything you can show ownership of, that owner can be your retirement plan. The only thing is, if you want your IRA or 401k to buy and own real estate, you still have to work through a company to act as the custodian of your IRA. So it's not treated as a distribution to you. When our clients tell us they want to buy real estate in their IRA, we don't hand them the money out of their IRA. That's a distribution, and that's one of the most common misconceptions on how this process works. When you have an IRA, directed IRA, and you want to buy real estate, we'll show you the process here in a sec, but all we're really doing is exchanging assets of IRA cash for assets of IRA real estate. Just like Fidelity exchanges assets of cash for assets of stock. And when you sell it, it goes back to an asset of cash. Money is not touching your hands as a distribution. We're just making investments. So we'll talk a little bit about the process here. But again, don't get confused on when we talk about self-directed IRAs, even because self-directed is just a marketing term. An IRA, directed IRA, legally is the same IRA at Fidelity. There's no difference there. The only difference is what the custodian will allow you to hold. So, are the types of plans that we have at Directed IRA that you can use to buy alternative investments, real estate, notes, cryptocurrency, and so forth. Well, we have 7 different types of plans. We have personal plans that can be self-directed. And again, all of these plans can own real estate. We'll talk about the process here in a second. The difference with these plans, though, is some are only for self-employed individuals. That's category 2. Okay. Some you have to have earned income to have, which is no different than any IRA rule anywhere else. But the thing here is when you look at these plans, airplane view, these plans are tax exempt trusts. Every one of these plans is tax exempt. Okay? You as a person and me as a person, we're not tax exempt. When I go out and buy real estate with my money, I have to pay taxes. Now, there's strategies on how I can minimize and defer those taxes, but I am a taxpayer. These plans, these 7 plans, are not taxpayers. When you put money into these plans, it's no longer your money. It's the money of the plan. Okay, you make a contribution to the plan, but the trade-off is the IRS says as long as you invest within this plan, if you buy and sell stock, if you buy and sell real estate, you don't have to pay any taxes on the gains. The only time taxes normally will kick in is when you decide to take money out as a distribution. But again, that's to you as a taxpayer. While the money's in the plan and while it's being invested, the plan is not a taxpayer. So in theory, your money grows much, much faster when it's in an IRA and it grows free of tax. There's no tax return that these plans have to report. There's no capital gains taxes that you have to worry about with Uncle Sam dipping his grubby little hands in there. All these plans are tax exempt. So category one, really anyone can have a traditional IRA or a Roth IRA. You have to have earned income to make contributions. Contributions are limited. They just went up, by the way. If you guys are interested, 2024, you can now make up to a $7,000 contribution to either a traditional or a Roth IRA. If you're above the age of 50, you can now make an $8,000 contribution. But don't forget, you can also make 2023 contributions still up until your tax filing deadline of April 15th. So right now, there's a lot of people that are making contributions for both last year and this year because we are in the new year. So anytime between now and basically April 15th, you can make 2 years contributions if you want to get more capital in those plans. There's no age restriction on these plans either. Okay. You don't have to be 18 or age of majority to have this plan. You just need earned income. I'll give you an example. I had a 4-year-old with a $75,000 Roth IRA. Now she was 9 when it got to 75,000. But how the heck does a 4-year-old have a Roth IRA to begin with? She was paid a modeling fee. Okay. The 4-year-old was on the cover of her grandmother's book that she sold to real estate investors. She paid her granddaughter a modeling fee of $5,000 that year at 4 years old. She used that income to make a contribution to granddaughter's Roth IRA, which she subsequently invested, self-directed, partnered with her own Roth IRA. And after a couple investments, that 4-year-old was 9 and had a $75,000 Roth IRA. Good job, Grandma, on kicking that grandchild up with a head start. So there's no age restrictions on those plans. You just need earned income in order to make a contribution. Now, another misconception to investing in real estate or investing in anything else with these plans is that you can only make that much money in the plan. Contributions and investment gains are completely different. They're not even in the same zip code. They're completely different. Contributions are what you take and put into the plan each year. There's a limit on that. But your investment gains can far exceed contributions. You can make hundreds of thousands of dollars, if not millions of dollars in gains, and that doesn't go against your annual contribution. If you guys want to look up Peter Thiel, one of the co-founders of PayPal, he has a $5 billion Roth IRA. Now, that was not from making contributions. Okay, that's from his investment gains. So don't get contribution confused with gains. Those are two completely different things. Contributions are limited, gains are not. Now, if you're self-employed, you have other items on the menu which you can self-direct, make contributions to, and buy real estate. That would be your SEP IRAs, your simple IRAs, or the mighty solo 401k. I would just say if you are a small business owner with no common law employees, basically no W-2 employees, that solo 401k is hard to beat on any level if you're looking to grow massive amounts of tax-free wealth. I don't have a whole lot of time to go into the details of the solo 401k or the other plans today, but we do have a webinar that we just hosted with me and Matt that we talked about the solo 401k specifically. So if you're self-employed though, you can also self-direct SEP IRAs, simple IRAs, and solo 401ks. Self-employed people can do both. I have clients that have a solo 401k for their business that they make large contributions to and self-direct, but they also have a Roth IRA. You can have both as long as you've got the income to justify the contributions to both. And then we also have plans that are not retirement plans that
Hey
are,
Nate, we have a
yep,
quick question.
sure.
Someone asked, so you have to be earning income, i.e. W-2 paid for to have a traditional self-directed IRA?
It doesn't have to be W-2. It can just be any type of income in order to have a traditional or Roth IRA. So if you're Schedule C, you can still make contributions to a traditional or Roth without paying yourself a W-2. You just have to have taxable income, okay? Earned income through through wages or commissions or sales or something like that. The only income that doesn't qualify as earned income would be things like Social Security and disability. Okay, so but as long as basically as long as you have earned income you're paying the taxes on, you can make a contribution to a traditional Roth. But if it's self-employed income, you can also make contributions to the employer plan. So I hope that answered that question. Now, the specialty plans are really cool. And I have a case study that will talk about this, but these are not retirement plans. They're tax sheltered, tax exempt trusts that you could put money in and take money out tax free based on the investment gains. And that would be your health savings accounts and the education savings accounts, with which are specifically geared towards self-directed IRA investors, but those would be your Coverdell education savings accounts. These are plans that you set up for your kids or your grandkids. Okay. Contributions are relatively small to the ESA. It's $2,000 per child per year. So if you've got 3 children, as long as they're under the age of 18, you can make a $2,000 contribution to each of your 3 children's ESA. They have an ESA for each. Now that we're in the new tax year, just like your traditional Roth, you can make contributions to an ESA for last year, and you can make contributions to an ESA for this year. So if you have not set up an ESA, that's okay. You could set one up today for one child and put $4,000 in. 2,000 for last year, 2,000 for this year. You don't have to make that large of a contribution. You could put $10 in if you want, as long as the investment that you need to make is a $10 investment. And I will show you how I have a client that does some wholesaling with his HSA and ESA as the buyer on the contract. All the wholesale fee, all the profit comes back to his accounts, and he uses it completely tax-free to pay for his health expenses and his children's private school education expenses completely tax-free.
Hey,
So just,
Nate,
yep, go ahead.
if you have earned income on a W-2, but it gets washed out with depreciation losses on rentals, is that considered earned income for IRAs?
Basically, what you're going to look at is you're going to look at your modified adjusted gross income. Okay. So if you are, let's just say, whatever the scenario is, you're whittling down your income to be zero, well, then you can't make a contribution to a traditional Roth or an employer plan. You have to show at least some income there left over in order to make a contribution to any of those plans. I'll just give you a real quick example. For your traditional Roth, for example, let's say that I make $10,000 for the year, but I use my depreciation and some expenses to whittle down my income all the way down to $2,000. Well, even though the contribution maximum is $7,000 for a Roth, because I only show 2,000, I can only make up to a $2,000 contribution. So for your personal plans, it's the lesser of your income up to $7,000. Now, the employer plans work a little bit differently. Solo 401ks, you can make contributions dollar for dollar up to, I think the new amount is $23,000 per year. But if you have like a SEP IRA, it's a fraction of your income. So it's roughly 20 to 25% of your income. I don't want to overcomplicate things. Check with your CPA, check with your accountant, figure out what type of income you're going to be left over with, and you can make a contribution based on your modified adjusted gross income. Now, here's another cool thing with IRAs that doesn't get mentioned a lot. You don't have to wait until your tax filing deadline to make contributions. Because I just mentioned that we have checks coming in the mail right now today for people making contributions for 2024. You don't have to show the income for 2024 yet because we just started the year. But I can max out a Roth IRA contribution of $7,000. The only thing I have to make sure of is by the time the year ends, I at least have $7,000 of income to justify that contribution. If I don't, let's just say I wound up with that $2,000 number I mentioned, but I made a contribution of seven, that's just called what's called an excess contribution. I can decide to take the excess amount out, which would be $5,000. Remember, I made a $7,000 contribution, just hypothetically today. I go through the year, I only show $2,000 of modified adjusted gross income. So I would have to either A, remove the $5,000 of excess to avoid a penalty, or I could just pay a 6% penalty and just leave the amount in. I've seen some clients actually do that where they max out their contribution early in the year. They come to the end of the year, they go, "Ooh, I'm a little bit over on my contribution amount, but it's already invested and it's making a certain amount of money. I'm just going to leave it in the account and just pay a 6% penalty." And it just applies, that excess amount will apply to the following year contribution. So good question. I know I kind of went off on a tangent there, but I think that's important for anybody to know.
Hey Nate, just to add to that, is it countable to qualify for income qualifying? That was a follow-up question.
Say that one more time.
Is it countable to qualify for income
Is it countable to
qualifying?
qualify? I'm not quite sure what that question means. Maybe you can reword that for me, Tony. But I see another question. Can I self-direct a 529 education plan? A great question. 529 plans are great. They're often, we talk about them a lot of times in the same breath as the ESA. 529 plans, unfortunately, cannot be self-directed. They're government sponsored. They're great savings plans, especially for college. If you want to stash some more money in to help, get some money invested in a tax-free manner, a 529 plan is great. The ESA is the only one that can be self-directed, but you can have both. I have parents that have 529 plans and they have ESAs for their children because they have investments, self-directed IRA investments or ESA investments that they want to make. And a lot of times I've seen them make more return on the ESAs than they could with the 529 plan because they get to pick the ESA investments. You don't necessarily get to pick or choose the 529 plus investment. So great question. So let's move on a little bit because we'll touch on all these plans when we get to the case studies. But what I want to make sure of is remember that the big difference with these plans, once you get the money in and you get it invested, the biggest difference and where the real magic is if you can use plans that are tax-free on the way out. Roth IRAs, Roth 401ks, health savings accounts, and education savings accounts are the plans that not only grow tax-free, but when you take the money out as a qualified distribution, the distributions are tax-free as well. So the reason why this is important is most people have what's called traditional IRAs. I'll just back up here in a second. A traditional IRA and a Roth IRA are taxed the opposite. When you put money in a traditional IRA, typically you get a tax deduction on that contribution. So I throw $7,000 in my traditional IRA, I get to write $7,000 off of my income that year. So I get an immediate tax benefit by paying taxes on $7,000 less of income. But it doesn't make the tax go away. It just defers it to the future. Future meaning when I take the money back out, it's treated as income to me. So I put 7 in, I get it to write it off. I take 7 grand out later, I add it back to my income. Now, this is great if you're not investing for large returns. If I'm investing for large returns and my returns are going to outweigh my contributions, what do you think is more important to me? Tax deductions on the small amount I put in or tax-free growth on the amount that I grow it? Okay, this is why I always say when someone says, well, what's better, Nate, a traditional or Roth? I go, it depends. It depends on how you're investing and whether or not the deductions on the contributions are going to outweigh your growth. Sometimes the investment is going to make that decision more than just, planning to put money in it. So with Roth IRAs and Roth 401ks, HSAs and ESAs, when you start applying real estate to that equation, this is why it's really important to not pass up on the opportunity to have a Roth IRA because now anybody nowadays can have a Roth IRA through what's called conversion. If you've got a traditional IRA with some pre-tax money in it, you can pay taxes on that money to convert it to a Roth. Now, why would you want to do that? I'm not going to spend too much time. I'll do a separate class on Roth conversions in a couple of weeks. But the difference is when you apply real estate, especially real estate that appreciates over time and that cash flows, if you can own it in an account that never pays tax, that's how rich get wealthy. I'll give you an example. I have a client that has 12 rental properties, all owned in a Roth IRA. Okay, not owned by him, not owned by his LLC, owned by his self-directed Roth IRA through a company like us. Now, those 12 rental properties are not his properties, they're owned by the Roth. All 12 rental properties are rented. Every around the 1st to the 5th of the month, his Roth IRA receives rental income from those properties. Now he's above the age of 59 and a half, and he's had his Roth IRA open for 5 years. So what's that mean for him? Once you're above 59 and a half and you've had a Roth for 5 years, you have what's called qualified distributions. Qualified distributions are tax-free and penalty-free for the rest of your life. So here's what happens every first of the month, first to the fifth of the month. He has about $15,000 of rental income come to his Roth IRA through the rental property owned by his Roth. He takes a tax-free, penalty-free distribution from his Roth IRA because he has qualified distributions, and he uses that for living expenses in retirement. The next month come, he takes another $15,000 out. The next month come, he takes another $15,000 out. Meanwhile, at the end of the year, his Roth IRA ending year balance goes up. Why? Because he's not touching any of the principal of those Roth IRA owned properties. They're increasing in value every single year. Even the most conservative numbers say real estate increases 5 to 7%, but he's not even worried about that. He's living tax-free off the distributions. If he had those investments in his name, well, he's a taxpayer, so he's have to kick back Uncle Sam a little bit of that money. Or if he owned those properties in a traditional IRA, the gains still work the same, where he's not taxed on the gains, but he's taxed on the distributions because it's a pre-tax account. So if you want to think about setting yourself up for a tax-free retirement with real estate, it's really important to identify, well, what type of plan do I want in retirement? Do I want to share every distribution with Uncle Sam, or do I want to pay the taxes now and get Uncle Sam out of the equation? Here's the other cool thing with these accounts that's again beats all other tax strategies in my mind because of the way that IRAs can be passed to your next to your beneficiaries or your next generation. When that client dies and passes away, okay, those 12 rental properties do not just disappear. Okay, they don't liquidate. Those 12 rental properties owned in his Roth IRA just becomes 12 rental properties owned in an inherited Roth IRA. Inherited Roth IRAs grow for at least another 10 years, completely tax-free to his beneficiaries. So when he dies, that Roth IRA turns into an inherited Roth IRA for his kids, and his kids get to live tax-free off distributions for at least another 10 years. Inherited IRAs can even be reinvested, but talk about a way to pass on generational wealth is not only do it tax-free, but do it tax-free 10 years after you're already gone. And I've seen no other strategy that eliminates taxes, not only for your life, but 10 years after you're gone through things like a Roth IRA or a Roth 401k. So it's powerful, powerful stuff. If you can match tax-free accounts like a Roth IRA to appreciating and cash flowing assets like real estate. I'm going to talk about partnering different accounts together, but I want to get into some of the benefits and some of the things you cannot do with an IRA, and then we'll talk about some case studies and show you how to actually put this in play. So why is real estate so attractive in a self-directed IRA? And this is not giving tax or investment advice, but just some things to think about, some food for thought. So one thing that's different between, say, just real estate, and if we're going to compare real estate to a stock, is that if my retirement account or even my personal cash, if I own stock, to me, stock's not tangible. What I mean by that is I have no collateral with stock. If I invest in a company and that company goes bankrupt, I have $0 as far as that investment goes because I have nothing of collateral. I don't own the company. I just own stock in that company. And if I pick the wrong companies, I lose everything. When I own real estate's tangible. It's like my desk, right? I can drive by, I can touch it, I can feel it. It's a tangible investment. It's not going anywhere. Will it go up and down in value? Sure, everything goes up and down in value. But if I own real estate, it doesn't disappear like a stock can. Again, no offense to stock, but there's a fundamental difference between real estate and a stock. The other thing that I would say is really important, whether you're a real estate expert or not, is just diversification. How well do you want your retirement diversified? If you have a wealth advisor that says, well, you're well diversified, we've got you in some high risk mutual funds, some medium risk mutual funds, and some low risk mutual funds, and voila, you're diversified. I would say you've still got all your eggs in one basket. You just got a bunch of mutual funds. If you look at The people that manage ultra wealthy, look at family offices, for example. If you ever look at the asset diversification of a family office, now these are advisors and people that are managing 10 to $50 million of investment capital. Look at the diversification makeup of their portfolios. 40 to 50% of the assets in a family office are alternative investments, things like real estate, things like commercial property, land. They don't hold a whole lot of stocks in their portfolios. Do you think that's by accident, or do you think that's intentional? Here's one thing that to note is there was an article actually in Forbes back in 2020. Okay, the IRS did an audit. The IRS did an audit on all the IRAs and retirement plans as to what type of assets they held within it. Okay, now this is a report done by the IRS. Go look it up. Forbes article, March of 2020. They said out of all the IRAs and 401ks out there, only about 2 to 3% of the assets in all the retirement plans out there hold alternative assets. Okay, things like real estate, things like land, things like, all the things that we kind of mentioned. Only 2 to 3%. But when you look at the IRAs valued above $5 million, okay, the largest IRAs out there, 25% of the assets in those plans are alternative assets. So this is not new. This is not a new way. The rich and the wealthy have been investing their retirement plans in alternatives for a long period of time. So the reason why I want to make that distinction is because you don't have to be a real estate expert to know that real estate or alternative investments is a good diversification tool. So just food for thought on that. Tax savings, again, we kind of talked about this, is if you're trying to get out of the rat race to retirement, the easiest way sometimes is not to make more money, it's just keep more money. Well, IRAs, 401ks, and other qualified plans, as I mentioned, allow you to keep more of your earnings because you get Uncle Sam out of the equation. Now, by no means am I saying you should only invest in a retirement plan. I think there's a lot of benefits to having real estate, especially when you look at depreciation. If you can offset your personal income, real estate's a great investment to do outside of an IRA. But it's also a great investment to do inside of an IRA if you're good at finding real estate investments. So you really should be doing both. Okay. If you understand real estate, you should be investing in real estate outside of an IRA, but you should also be investing in real estate inside of an IRA because you'll get further down the road when you eliminate Uncle Sam as much as you can. But the most important thing is it just allows you to invest in what you know best. IRAs and 401ks can be invested in anything. I always just tell clients, invest in what you're knowledgeable about. If you're knowledgeable about real estate, invest your IRA in real estate. If you're knowledgeable about stocks, invest your IRA in stocks. If you're knowledgeable about medical equipment, I had a client make a ton of money in medical equipment. He self-directed his IRA, Roth IRA, to buy and sell pieces of medical companies and medical device companies. And startup companies is a big one. I've had clients in Texas invest their IRAs into oil and gas leases. So we're talking more about real estate, but again, invest in what you know. Every investment's a risk. You're gonna make more money in the long run, I would say, investing in the things that you understand or are knowledgeable about. So let's talk about some IRA rules first, real quick, and then we'll talk about the case studies. When you look at the IRS code, the IRS is, again, very lenient as to what we invest in. They're a little bit more strict on who we invest with or who our IRAs transact with. There's really three categories of restrictions, and it's important to just touch on this, especially when you talk about self-directed IRAs. And don't forget, self-directed is just a marketing term. But when you have the keys in your hand and you're picking the investments, you need to understand these rules. Now, these are the same rules as an IRA Fidelity. It's just you never run into the people restrictions and the transaction restrictions because you're just buying and selling investments from Wall Street. But when you self-direct your retirement plan, now you're dealing in a more private arena. You're dealing with private investments, and it's important to understand who your IRA is not allowed to transact with. The main thing is you got to understand who the disqualified people are to your IRA. Disqualified persons are people that cannot transact with the IRA or 401k or HSA in question. Remember that you and your plan are two separate people. When you put money in the plan, that money now belongs to the plan. When you invest in that plan, the assets belong to the plan. you really get no benefit until you take a distribution. That's when it becomes yours. Okay. But until that point, your relationship to your plan, whatever that plan is you're the fiduciary to that plan. You have a job to put money in it, to invest it, and grow it so that you have something to retire on. And the IRS says, as long as you do that and follow our rules, we'll pay, you have to pay no taxes, or your retirement plan pays no taxes to us. Okay. So remember that you and your retirement plan are two separate people. With that being said, since you are the fiduciary to your plan, you're not allowed to self deal with your plan, meaning I can't take things that I own personally and sell it to my IRA. That's a conflict of interest. I make decisions for both parties. My plan has to be invested in investments that do not have anything to do with me or other disqualified people. Okay. I'll talk about the disqualified people here in a second, but what disqualified people are not allowed to do with their plan is they can't buy things from their plan, they can't sell things to their plan, they can't trade assets between them and their plan, they can't loan to their plan or take a loan from the plan unless it's a 401k. That's a whole different topic. And you're not allowed to extend services to the plan. Now, extended services is a gray area. What we're talking about when we're talking about extending services is, I'll just give you a quick, easy example. If my IRA is going to go out and buy and own a house, a rental property, okay, I can pick contractors to work on that property, but I can't be the contractor that works it. That's an extension of a service. I'm extending goods and services to my IRA's investment. I have to stay at arm's length. So as long as I'm using my brain to quarterback the investment, put people in place to help that investment grow, okay, I'm fine and I'm within the rules. But I can't act as the contractor. I can't live in the house. I can't go out and get financing to help my IRA buy property. That would be an extension of a service. The first four are pretty self-explanatory, though. But disqualified people aren't allowed to buy, sell, trade, loan, or extend services to or from their IRA.
Hey
The,
Nate, quick question. Is the tax-free distribution the same if the real estate is owned by an LLC that is owned by the IRA?
Great question. And we're going to talk a little bit more about that, but I'll touch on that. If you have an LLC and your IRA owns the LLC, but then the LLC owns a house, that LLC is just considered a pass-through entity. Taxes don't kick in at the LLC level, they're going to kick in at the IRA level. So the LLC is just used as a vehicle for ease of use. It doesn't do anything for taxes. So to answer your question, my Roth IRA owns an LLC. That LLC owns a house. All my distributions, when they come back to my Roth IRA, are still going to be tax-free and penalty-free. The LLC doesn't change that whatsoever. Good question. Was there another question, Cass?
No, that's all for now, and
Okay.
then we can get to the next one later.
Okay. The other people that are disqualified to your IRA, here's where the IRS is more stingy. They do not want your IRA or plans transacting with you, the IRA owner, your spouse, your parents or grandparents, lineal ascendants, we call them, or lineal descendants, which would be kids, grandkids, and their spouses. Now, the reason they disqualify those people, spouses and lineage, is that's usually how wealth is passed. When somebody dies, their IRA usually passes to the spouse or to the kids. It usually doesn't pass sideways to other family members like brothers, sisters, aunts, uncles, cousins, nieces, nephews. Those are family to the side. In the IRA world, those family members are not considered disqualified. The only ones that are considered disqualified are me, spouse, parents, grandparents, kids, and grandkids, and their spouses. This also includes any LLC, kind of similar to the question. The LLC, if an LLC my son owns, does not isolate this from a prohibited transaction. Any LLCs or entities that those same family members would own are also considered disqualified. But don't let that stop you. There's so many other people that your IRA could be doing business with. The IRS just doesn't want your IRA doing business with those specific family members. Myself, self-dealing, my spouse, parents, grandparents, kids, and grandkids. But it's okay for your IRA to invest in deals from your brother or your sister or family to the side. So remember that your benefit from these plans comes from the tax-free or tax-exempt distributions. Okay, that's when you get your distribution. Until that time, your IRA is a separate entity. You're supposed to pick investments to help it grow, and if you use the right plan, you live off the tax-free distributions from those plans.
Hey,
Just so,
Nate,
yeah, go ahead.
for the SDIRA that owns rentals, is it true since there's no annual tax filing, I cannot capture annual property depreciation and operational expenses as a deduction for that year?
Correct, because that's an investment your IRA owns. Now, that's also a misconception. Be careful with people that say, why would you ever invest in real estate if you don't get depreciation? Well, what's the reason I want depreciation? It's to offset taxes. Okay. If I have taxes to offset, I'm going to go buy real estate outside of my IRA to help me offset those taxes. But as far as my IRA goes, my IRA is not a taxpayer. The whole reason I don't get depreciation is because there's no tax to depreciate against. So what would I rather have? Taxes that I have to find depreciation for, or just no taxes at all? I would rather take no taxes at all. So I've run into CPAs. It's crazy how they think so in the box. They think, well, why would you ever buy real estate in an IRA when you don't get depreciation? Well, because I don't need depreciation if I'm not paying tax. So are you telling me, Mr. CPA, that I should invest in stocks just because I don't get depreciation? Stocks I understand less about and I make less money for just because I don't get depreciation on real estate? I'm going to invest on what makes me more return. I actually invest in notes. Notes have made me more return than any stock has ever made me in my life. Okay. If I find a good real estate deal, I'm going to invest in real estate. Why? Because I understand it and I make better return. But that's a great question. You're not going to use the depreciation on your IRA's investment to offset personal taxes. Because remember, you're two separate people. But this is a good reason that you should be doing both: investing in real estate outside of an IRA, but also investing inside of an IRA. Forget about the depreciation. Look at where am I going to get the best cash on cash return and invest your IRA there. So now, when I talk about what you can't do with an IRA, don't get confused with transacting with an IRA versus partnering. And I want to set this up because this is going to be the first case study I go over, is how you can actually partner. You can partner with your IRA as long as you're on the same side of the fence. I'll just give you a quick example. Let's say I've got $50,000 in my IRA and $50,000 personally. Now, I can't transact and sell things between me and my IRA. Let's say Cassandra, for example, Cassandra is not related to me. Let's say Cassandra has a house that she's looking to sell. Cassandra is a non-disqualified person to me and my IRA. So if Cassandra was selling a house for $100,000, me and my IRA together could buy that rental property from Cassandra because she's on the other side of the fence. I'm not transacting with my IRA, I'm transacting with Cassandra. Now, I'm not the biggest fan of partnering with your IRA, but this actually goes back to that question the gentleman had about depreciation. If I partnered with my IRA as two purchasers, me and IRA, I would be able to recapture 50% of the depreciation or whatever the amount is I invested personally. The amount that's invested from my IRA would just go back to my IRA, either tax exempt or tax free. Now, we don't see very often people partnering with IRAs because the accounting of it can be a little messy. Can you do it? Yes, you can do it. What we see more often is IRAs partnering with other IRAs. For instance, husband and wife's IRAs. Those are two different buyers. Husband and brothers, our person and brother's IRA. I've seen 14 IRAs partnered on one property before, but that is a way to get all of your accounts moving at the same time, is by looking at investments that maybe you can partner different accounts together on. So let's look at a real deal. So had a client, Dan and Denise. They had a property that they wanted to flip in their area. Now they're both in high tax brackets. They weren't full-time real estate investors, so they didn't really have much of a need for depreciation because remember, most of the time when you're buying real estate outside of an IRA, you're only going to be able to use depreciation if you have the right type of income to depreciate against. A lot of times your W-2 income, you're not going to be able to use depreciation to offset that. So they had pretty good jobs, but they liked real estate. They even they had dabbled in some real estate outside of an IRA, but they had just left their jobs and they had some old former employer 401ks that had been rolled into IRAs at Fidelity. Okay. Dan had a traditional IRA. Denise had a Roth IRA. Now, they identified that they wanted to buy property in their town, but they knew they had to set up an account with a self-directed IRA custodian if they wanted to use their IRAs to own that property. So, step one, the first thing you do is just set up or establish a self-directed IRA with Directed IRA. You just go online, you pick the type of account you want, you set it up. You can literally have an account open within 24 hours. Traditional, Roth, SEP, simple. 401k takes a little bit more time to set up, but HSAs and ESAs can all be set up literally in 5 to 10 minutes online. So step one, establish your account. Step two is you fund the account. There's three ways you can fund your self-directed IRA. One, the most common is just transferring some money in from the IRA at Fidelity or Charles Schwab, wherever it is. This is not a taxable event, by the way. All you do is once you've got the account open at Directed IRA, you fill out a transfer form with us. We fax or wire that. We fax or email that transfer form to Fidelity or Charles Schwab, and then they wire the funds directly into the account here. It's not treated as a distribution. IRA to IRA transfers aren't even reported to the IRS. You can transfer between IRAs as many times as you want. And I would actually say that's probably wise to keep an IRA at Fidelity or Charles Schwab and an IRA here so you can move money back and forth depending on where you need to invest it. But considering they wanted to buy real estate, they had to move it to a plan that would allow them to buy real estate. So they each set up IRAs. Dan, a traditional IRA, Denise, a Roth IRA. They both completed transfer forms. We sent those transfer forms to Fidelity. Fidelity wired $150,000 each from each of their IRAs there to their IRAs here. Now, the reason they did 150 each is because the property they were looking at, they were negotiating, it was going to be a little bit less than $300,000, but they wanted to move in a little extra to account for the rehab. Okay, if you're going to buy property and there's going to be some fixes that need to be done, you need to make sure that you've got enough money in the IRA so that we can pay contractors or pay those expenses. So they moved over $300,000 total, 150 to each plan, okay, through a transfer request. The ways you can move money in are a rollover from an old 401k or old employer plan, or they could have just made a contribution. Now, obviously, contributions are limited. So it's because they needed $300,000, they transferred some money in from their Fidelity accounts. Step three is where you're going to work with our Directed IRA transaction processing team so that we can purchase the property in the name of the IRAs. Remember, we're not handing the money to Denise or Dan. Okay, we're going to exchange their asset of IRA cash for an asset of real estate. And I'll show you how that works. So once we get the accounts open, established, and funded, okay, Dan and Denise go out and they negotiate terms with the seller. We do not participate in the negotiation of the terms. That's still your responsibility as a self-directed IRA. But Dan and Denise negotiate the sales terms with the seller. They negotiate a purchase price of $270,000. The difference is, the only main difference is the buyers on the contract are not Denise and Dan. The buyers on the contract are Denise and Dan's IRAs, and they have a special vesting. Right when you open an account, you get the vesting that basically titles everything in the name of your IRA. Here it would be Directed Trust Company. FBO stands for the benefit of. Dan Jackson's IRA, that's buyer number one. Buyer number two on the contract is Directed Trust Company, FBO, Denise Jackson's Roth IRA. We want to make sure that we have that distinction. Dan has a traditional IRA, Denise has a Roth IRA. The purchase contract will indicate each IRA. When it comes to signing the purchase contract, we sign as the buyer. We don't tell them it's a good or bad investment. We just take Dan and Denise's instructions to sign the contract as the buyer, and they fill out one form, which is called our direction of investment form. It just basically says, Directed IRA, I give you the authority to use our IRAs to buy this property at this address and wire the money here. Okay, it's really self-explanatory. You give us that form, copy of the contract, we sign the contract, and then we go with what the terms of the contract is. In this case, we were instructed to send $5,000 earnest money to the title company. That wasn't given to Dan and Denise. It was sent directly to the title company via wire. $2,500 from Dan's account, $2,500 from Denise's account. Okay, we work with Dan and Denise on the closing paperwork. Any paperwork that needs to be signed is signed by us, the buyer, but Dan and Denise have to tell us that they approve us to sign it. So basically what they normally will do is just write read and approved on any document that requires a signature. That way we know Dan and Denise have approved the terms. We sign the contract and we send that back to the agent. So you're just working through us as a third party through this whole transaction. Once we get to the end of the transaction, here's how the warranty deed is drafted. The warranty deed shows the owner of record as Directed Trust Company, FBO, Dan Jackson's IRA, and a lot of times it'll follow with something like this, as to the undivided interest of 50%. And then also owner number 2, Directed Trust Company, FBO, Denise Jackson's Roth IRA, to the undivided interest of 50%. It doesn't have to be 50-50, but it has to be consistent with the amount of capital that's invested in from the beginning. So could it have been 70-30? Sure, that would reflect that on the warranty deed. In this case, they just did an equal amount, 2 different IRAs, but equal capital amount up front. The warranty deed is sent to us and stored here at Directed Trust Company. That's evidence of the investment. That's evidence of the IRAs owning a rental property. It's no different than Fidelity. What they hold is a stock certificate. They hold stock certificates. We hold warranty deeds, both valid IRA investments. Now, the important thing to know is that all expenses must be paid, in this case, out of their IRA. We have a form for that too. So in this case, they had a contractor lined up. The contractor needed $20,000 to begin the repairs. So Dan and Denise just fill out what's called a payment authorization. They send that to us. We take 50-50 because they're owned 50-50. We take $10,000 out of one account, $10,000 out of another, send one wire or check to the contractor so that he can begin repairs. And when income comes back in, whether it's rental income or income from the sale, all of that money is going to come back straight from the title company, deposited directly back into their IRAs. Remember, no money is being exchanged between Dan and Denise. They're just quarterbacking the transaction and telling their IRA custodian to send money there and collect money here. So all of the profit is still considered tax exempt. Now, when they sold this property, all the gains go back to their IRAs, split pro rata, 50-50 amongst the 2 accounts that they use. So just round numbers here, using round numbers, their purchase price was $270,000. Remember, 50-50 from each IRA. They rounded up the repairs and expenses to $25,000. So they're all in for $295, 50-50 from each IRA, traditional and Roth. They sold the property for about $405,000 after holding costs, after expenses, after commissions. They netted about $87,000, split pro rata. So Dan's IRA received a tax deferred gain, because it's traditional, of $43,500. And Denise's Roth IRA received a tax-free gain of $43,500. Now, because they're both still in the IRA, they still have that amount of money to reinvest into their next deal. Dan's only going to feel the tax effect if he takes a distribution in retirement. So their money's still going to grow about the same rate if they're invested in the same things. If you follow my train of thought, it's just going to feel different when Dan takes a distribution versus Denise takes a distribution.
Hey, Nate, we have
Yep.
some questions on this.
Yep.
If you have an LLC owned by an IRA, who signs the contract?
Great question. The manager of the LLC will sign the contract. So in the event, let's say that you wanted to, and I'm actually going to talk about on the next slide. Let's say that Denise and Dan, instead of owning the property directly, they wanted to invest their IRAs into an LLC and have the LLC own the property. And that's perfectly allowable. We can do that. We do tons of those, and we actually will set up the LLC. Our law firm will set up the LLC for you. In that case, all we're funding as a transaction is the private entity transaction into the LLC. In that case, what Denise and Dan would have gave us is not a purchase contract. They would have gave us the operating agreement for the LLC and a direction of investment form for a LLC investment. We would have sent all the money, let's just say $300,000, to the LLC checking account. But now that it's in the checking account, our hands are really off. At that point, it's the manager of the LLC who has access to the checking account that will write the checks. And when they make the purchase will be in the name of the LLC, not the IRAs. Okay, I hope that answered the question. Was there another question?
Yes. And is there an IRA/LLC involved in this case study? And then to piggyback off of that, in this case, would it be easier for them to use an LLC?
So you guys are jumping ahead. That's great, but I'm going to talk about that on the next slide. So just hold that thought. I'm going to talk about the pros and cons with an LLC. Was there another question besides that?
No, we can move on.
Okay, all right, cool. So let's talk about other key points to remember, and I'll talk about the LLC right here at the end. You'll see it there. Dan and Denise were in full control of the investment decisions from start to finish. Directed IRA and Directed Trust Company just acted as their third-party custodian to make sure the investment was IRS compliant, and they retained all the tax exempt status for their IRA and the investment that they made. No monies were given to Dan and Denise as a distribution. We're exchanging an asset of cash for an asset of real estate, and when they tell us to sell it, it goes back to an asset of cash. Now, they're not required to set up another entity such as an LLC, but they could. Okay. Now, here's where this, and you'll hear this term, checkbook IRA LLC. All that really means is we'll help you set up an LLC. It's important to know which IRAs you want involved in ownership of the LLC. You can have a single member LLC where just one IRA owns it, or you can have a multi-member LLC where multiple IRAs own it. Again, you can have 9, 10, 11 IRAs own an LLC if you want. Now, you or even a disqualified person can be listed as the manager of that LLC. You don't have ownership over that LLC, but you are the manager of that LLC, which comes with a lot of responsibility. So I don't always encourage everyone to set this up. I only encourage people to look at this if you're going to be very active as a self-directed IRA investor. It may be easier for you to have the checkbook. And if you're a wheeler and dealer and you're getting deals over the weekend, it might just be easier for you to make offers in the name of the LLC. If you're just going to do one or two investments and you don't really need access to the checkbook, if you can wait 24 to 48 hours for us to sign documents and send checks, which most of our clients do it that way, then you eliminate the added expense of the LLC, which is a pro. Okay. You also eliminate, if you have a multi-member LLC, a lot of times you're going to have to, that LLC is going to have to complete a partnership tax return. Okay, not that any taxes are owed, but multi-member LLCs have some requirements as far as filing and return. So again, it's not a setup everybody needs to have, but if you're going to be active, it could save you in expenses, but it could save you really in just the ease of use that the LLC checking account gives you. I will say probably only less than 20% of our clients have checkbook IRA LLCs. The other clients are just buying, a rental property, maybe a note. And in those cases, you probably don't need the additional headache of an LLC to do certain other investments. So it just depends as to whether or not you want to use that or not. So let's talk real quick as I wrap up. Do you need hundreds of thousands of dollars to buy real estate in an IRA? And I would say no, because IRAs can use leverage or you can be as creative as you want as long as you're using your IRA as the buyer. Okay, I'm going to skip this one. This is actually a really good investment strategy. A client of mine, you can watch this one. This is an older one, but I have a client that has 5 rental properties in a Roth IRA that he only started with $70,000. Now you ask the question, how did he buy 5 rental properties with $70,000? His IRA is the owner, but his IRA was taking title to property subject to underlying financing that was already on the property. So you hear a lot of these gurus coming out, a lot of people talking about buying property subject to. Subject to has been around for decades. I've had a client buying subject to properties in a Roth IRA since 2012. But it's a great investment strategy because what you're allowing your IRA to do, a small, say, Roth IRA of $70,000, is leverage financing from a bank. Now, in this case, when you're buying property subject to with the Roth IRA, you're leveraging the financing somebody else already got, which is actually fine in the IRA world. But you could also, there's banks that have IRA loans. There's Titan Bank, for example, North American Savings Bank, First Western Federal. If you go to our website, we have a resource page that has some of the IRA lenders. Your IRA can just come in with a down payment and leverage bank financing to help it purchase more property or help it purchase property that you don't have enough money in your IRA to do on its own. So you could do that through acquiring financing at the time of acquisition or inheriting financing through acquisition like subject to. So basically, long story short, because I want to get to the next one, he started with $70,000, bought 5 properties in Texas, all subject to the underlying financing. He's had them for over 10 years now. And all of it that's been happening ever since he took title to those properties is he's had renters in those properties ever since day one. The renters have been paying rent to his Roth IRA. his Roth IRA has been using that rent to pay off the mortgage payment. And round he goes. The mortgages on all those properties are all fixed rate mortgages. So the interest rates don't change. So think about the interest rates he's gotten many years ago, but it doesn't change. The only thing that really changes on that mortgage payment is maybe taxes and insurance go up a little bit. But what's going up faster than taxes and insurance, do you think, is the rents in the area? So as the rents increase over time, what he's doing is taking the excess rental income generated in his Roth IRA and accelerating the principal pay down on the notes. In about 5 years, all 5 of those properties will be owned free and clear in his Roth IRA. And all 5 of those properties are in Austin and surrounding areas. So if you guys have ever been to Austin, a property in Austin, probably today, at least $700,000 to $800,000. In 5 years, let's just call it $800,000 to $900,000. So with a $70,000 Roth IRA investment, taking title to property subject to 5 properties, he's going to wind up with about a $4 million Roth IRA. Thank you, renters, for paying off the notes for him. And I noticed somebody said, well, what about UBIT? I don't want to get too off in the weeds on UBIT, but UBIT is a tax that your IRA has to pay when it has debt on the investments. Here's the cool thing with a strategy like this is unrelated debt finance income tax on the amount that you borrow. You can use depreciation and expenses to offset it. So every year, his IRA is considered a taxpayer because it has debt on the property, but it's only taxed on the net income. Now that he's got a rental, now he's got a mortgage payment and he can use depreciation and expense. He doesn't have much net income every single year. So the rental income is almost washed away with all those deductions. When it comes to the capital gains, here's the cool thing about unrelated debt finance income tax, which is what he would have to worry about here. You only have to pay taxes on the debt when you sell the property. He hasn't sold the properties. He doesn't plan on selling the properties until the notes are paid off and there's no debt. So if he sells the property, any of these properties, all they're going to do is look back 12 months. If there's no debt on the property 12 months prior to sale, how much taxes do you pay on the gains? Zero. So even though he started with highly debt leveraged investments, by the time the notes are paid off, there's going to be zero debt, which means he pays zero capital gains tax. So don't get that tax. Don't let it scare you. If you strategize it well and do it for buy and holds like this, you can actually eliminate a lot of the taxes. And I would say his cash on cash return doing that investment strategy versus trying to find one property to buy cash for $70,000. I mean, you guys, I don't have to explain that to you guys. Think how much more money he's made doing it that way, even though he was not scared of the UBIT versus him trying to avoid the UBIT and just do $70,000 cash transactions. So again, great strategy. If you guys want this presentation, just email me. I got my email at the end. Just email me and I'll send it to you guys. This is the one I wanted to show here is because I wanted to make sure and touch on, I know we're a little over, I wanted to touch on the other accounts that are not retirement accounts and how they can be used to profit and use tax-free dollars today. Okay, wholesaling, again, I use wholesaling because it's kind of an easy concept to understand. I've had a lot of clients wholesale, but wholesaling is one of those strategies where you can make money in weeks. Now, when you're thinking about the self-directed plans, remember, your self-directed retirement plan, sometimes you may have to wait until 59 and a half to get the tax-free distributions. Even on a Roth IRA, you got to wait till 59 and a half. If you want to use the money today, though, if it's an investment that profits today, then why not use an account that you could take the money out immediately and not have to pay taxes on the distributions? And that would be your health savings accounts and education savings accounts for your kids. So make it real quick. I have a client named Robert. He's got 2 kids that go to private school. Okay. Robert's a real estate investor. Robert also has expenses that he needs to pay today, and that would be healthcare and education expenses. Now, several years back, he set up these accounts. He set up a self-directed health savings account and 2 self-directed ESAs, one for each of his children, Maria and Alex. And he didn't max out the contributions, by the way, guys. The contributions exceed what he put in there. He just put in what he needed to invest. So on his HSA, he made a contribution of $500, and the ESAs, the ESAs, he put each $250 per child. So that's just a total of $1,000. His intention was he's going to go find a property that he can wholesale, put the buyers on the contract, his three accounts there, the HSA and his two children's ESA, have directed trust company sign the contract, directed trust company send the earnest money deposit, and then find a buyer and end buyer and negotiate a wholesale fee. Now, because Robert is not the buyer on this, he's just quarterbacking the deal. The buyers are his HSA and his two children's ESAs, funded and transacted through us. When the wholesale fee is realized at the time of closing, the wholesale fee comes right back to those accounts pro rata. Okay, so he put $500 in from his HSA, so that's $50,000, 50% of the $1,000 earnest money. So it gets 50% of the profit, and the two ESAs get 25% of the profit each. He wholesaled this contract for 30 grand, giving his HSA $15,000 of tax-free income that he can distribute the same day he earns it, provided he takes that 15K to pay for any qualified health expense, co-pays, dental work, root canals, vision, prescriptions, right? As long as he's taking it out to pay for that, he'll never pay taxes or penalties on those distributions. And the ESAs, you could take the profit, which was $7,500 each to each of these accounts. He took $7,500 out. He actually even just told us to send $7,500 checks to their private school to help pay for their private school tuition for that year. All he did here was do an investment he was going to do already, do it in three plans that wouldn't pay tax. Once he started learning this, his whole mind shifted because he thought, not only can I save for retirement, but with very little money out of pocket, I can pay for today's expenses with tax-free dollars. As soon as you start paying for education expenses and health expenses with tax-free dollars, this stuff all really starts to make sense. So I would say, as a rule of thumb, you should have Roth IRAs for you and spouse. If your kids have earned income, you should have Roth IRAs for them. If you've got health expenses and you've got a qualifying health insurance, you should have an HSA and you should have ESAs for each of your kids. Get Uncle Sam out of the equation for retirement and current expenses, and thank me later. If you match the right plan to the right investments and your need for money, taxes become less of a hurdle. Okay, it's really just about getting Uncle Sam out of the equation. I love investing in real estate outside of an IRA, but I love it even more inside of an IRA or an HSA, especially if you're knowledgeable about it. But just understand that there's plans out there that you can eliminate taxes forever if you plan it out right. But my challenge to you guys is I do a lot of these, and I've noticed a very small percentage of the people, they get excited, but they don't do anything because they didn't do their first deal. Once you do your first deal in these accounts, it's like riding a bike. It becomes easier and easier. Start small. Start with a wholesale deal if you want. But if you're investing in real estate already, I would probably say, why aren't you investing in real estate with your retirement plan, especially if you've got one parked at a Fidelity or a Charles Schwab? It's easy to start. All you got to do, remember, open it, fund it, self-direct it. Opening it, just go online. I've got a special promo here. If you guys want $100 off, I'll give you $100 off. Just go. You can do it from your phone, literally in 5 minutes. Fund it with a transfer or a rollover. Just make a contribution. Remember, we're in 2024, so you can double up on your contributions now. And then self-direct it. Work with us on what you want to invest in, and realize those gains, and let your IRA grow through the investments that you choose. So if anybody wants $100 off any account that we offer, just use that promo code right there, RYR100 on your applications. Get you $100 off any account that you open, whether that's traditional Roth, yada, yada, yada. Or if you want to talk a little bit more about it, scan that QR code. You can book a call directly with me. We can talk about the types of plans you have. I can answer any questions, because I know I'm not going to get all to the questions today, but we could talk about UBID and all the advanced stuff if you want. I want to try to keep it basic, or just shoot me an email. If you got a quick question, just shoot me an email at nate.hare@directedira.com. I hope this was helpful. I know I went over, but we had a lot of good questions. I'm still going to stick around to answer any questions. Cass, can you help me out with that? See if we got any questions.
Of course.
We got a lot of people on, so I appreciate that.
Yeah, let's go in order here. Jonathan, your one question is an add-on to Darren's. So I'll take a look at that in a second. But the next question is there not UBIT when buying a property sub-do?
Sub 2? Yes.
Sub two, sorry.
Yeah, so I did mention that. Anytime your IRA's investment is debt leverage, got debt on it, okay, your IRA is subject to UBIT. Now, I just say subject to UBIT because now that your IRA becomes a taxpayer, like I mentioned earlier, your IRA can now use expenses and even depreciation, okay, to help whittle down some of that income. But when it comes to the capital gain or your tax on the capital gain isn't going to even take effect until you sell the property. So, as I showed you with Paul is my client that has taken 5 properties subject to. He's going to pay zero taxes on the capital gains, even though his IRA is subject to UBIT, because he's going to wait until the debt is paid off from the renter. And if you own the properties 12 months past that point, you pay zero taxes in capital gains. Now, here's another way. If you're self-employed, if you're going to buy debt leverage property, okay, if that's your intended strategy and you're self-employed, here's another way around that tax. Just do that same investment in a 401k. 401ks, solo 401ks have a built-in exemption to that tax. You don't even have to pay it. So I have a lot of clients that have taken $6,000 investments. I have a client that took a $6,000 Roth 401k investment, bought 3 warehouses, okay, with seller financing. Again, this would normally trigger UBIT to an IRA, but because he did the investment in the name of his 401k, 401ks don't even have to pay that tax. There's an exemption. So again, don't get scared of that tax. People always think that's the worst thing in the world. No, there's ways around it. There's ways to eliminate it. And to be honest, if you're facing a tax, that means you're making money. So a lot of times it's not even the tax that should scare you away. You should look at what's the best strategy that gives me the most cash on cash return, regardless of the tax. The tax is just a number that I have to account for, but look at your cash on cash return. Sometimes debt used responsibly will increase your cash on cash return to your IRAs even after paying the tax.
All right, next question. I own a 270,000 in a 529. How can I switch from stock to a self-directed IRA? And do you have any conversion solutions?
So in a 529, that's tough because if that's all in a 529, because it sounds like you're asking 2 questions, I could be wrong, but in a 529 is that education savings plan. Unfortunately, there's just no way to move that in any self-directed plan. It can't be rolled over or transferred into a self-directed plan. Now, if you're talking about just a like IRA, or that's easy to get over to a self-directed plan. I would say the question more, and I thought you were alluding to it. I think you mentioned conversion is just analyzing whether or not you want to convert your existing pre-tax IRA to a Roth IRA first. Now, on the 529 plan, what you could do is if it really is all in 529 money, at some point, I mean, I don't know if you're going to use all $270,000, but that money's got to go somewhere. So a lot of people, what they do is if they've got some excess money that comes out to them personally, well, then they take that money and start making contributions to a self-directed plan. So you can't roll it directly from a 529 to a self-directed plan, but if you take it out to yourself and it's yours, well, then you can use that money to make contributions. And if you're self-employed, well, remember, self-employed, the 401k and the SEP, for example, you can contribute up to, say, $69,000 a year into those plans, provided you have the right amount of income to make that contribution. If you're interested in understanding how the contributions work and how you can max out solo 401k contributions, go to our CEO, Matt Sorensen. Me and him just did a podcast that's on YouTube that talks about the max contributions that you can make and how to make those in a 401k. So I hope that answered the question. I wasn't too sure on where you were going with that, but I hope that answered the question. Go ahead, Cass.
All right. So this is question. So can you buy a property under your IRA and then get a refinance mortgage on it to reimburse the IRA? So meaning instead of borrowing and then buying, you do it in reverse and you consider the mortgage as funding that property and then take the IRA money and buy another property.
100%. So the key to using that strategy is you have to work with a bank that will loan money to your IRA. And there's a lot of them out there. You'd be surprised how many banks actually have IRA products. But loaning to an IRA is different to loaning to a person. The banks that loan to IRAs, they do what's called a non-recourse loan. So all that means is non-recourse is the bank loaning on that property only has recourse to the property, doesn't have recourse to you, the person, because you don't own it, and doesn't have recourse to your IRA's other assets, which is a good thing. So as long as the loan is non-recourse, you can cash out some of the equity on one of your IRA properties and go make repairs or just go buy more property. Sometimes that's advantageous because there's different loan programs that are better suited for you if you do it that way. If you buy it without debt and then you get a new appraised value, for example, and you cash out some of the equity, you can use that equity to go buy property. I've had clients buy one property and they end up with, in 2 years, they wind up with three because they were able to cash out some of the equity and go buy other properties with other debt as well. So yes, the answer is yes, you can do that.
Perfect. What is the nature of the built-in UBIT avoidance with a 401k, and is it self-directed?
It's just an exemption. It's right there it's right there in the plan documents. So 401ks, any 401k really, it's the same rule for 401ks. There's an exemption to, and I want to be specific here because UBIT is kind of there's an umbrella with UBIT. It covers a lot of different investments that could be taxed. There's really three investments that trigger UBIT in an IRA or 401k. One is if your IRA or 401k owns a business that generates operating income, okay, like a Pizza Hut or something. Now that's a different type of UBIT. Okay. Also, another trigger is if you buy personal property and lease personal property, things like mobile homes, boats, cars, personal property subject to UBIT. But then there's a subcategory of UBIT, which is unrelated debt finance income tax, which is the one we've been talking about today, which is when your IRA or 401k owns a property with debt. The 401k tax exemption is just to that piece, which is normally fine. It doesn't give you an exemption to buy businesses tax-free or personal property tax-free, but it does have the built-in exemption to pay no taxes on real estate that has debt on it, as long as you do it in a 401k.
Perfect. All right, next question. I have a self-directed Roth IRA account. If I want to buy property but do not have enough to cover the full purchase price, what options do we have to make up for the rest?
Great question. So we kind of touched on one, but we didn't touch on some others. So one is you can go get financing from a bank. That's one way to help. But remember, if you're using an IRA, you could be triggering UBIT, and you got to just work or navigate through that. A better way really is just partnering. Partner with somebody else that has some IRA funds, or even somebody that has personal funds. I've partnered on deals where it wasn't all IRA investments. I've done notes where it was 4 or 5 IRAs and 2 people, right? So the reason we got those 2 people is because we needed a little bit more to fund the entire note balance at funding. So if you're looking to buy property, your IRA can get debt. Okay, your IRA can partner. Your IRA can also joint venture. Okay, so those are other ways that your IRA can use other buckets of money to help it buy property if there's not enough money in the one IRA that you're looking at. What I always remind people, a lot of times when I talk to people on the phone, they just didn't realize, oh, I can use my HSA, and oh, I can make contributions to my kids' ESA. So sometimes they've got money lying around. They just didn't realize that they can put it in these other plans that can be self-directed. So partnering is one of the easiest solutions to buying investments if you're just focused on the money you have in one plan. Look for partners.
What do you recommend?
And that avoids UBIT, because partners are not debt. Partners are partners. So if you want to bypass or just not even worry about UBIT, partnering and joint ventures do not trigger UBIT.
All right. Why you just mentioned UBIT. What a strategy to avoid UBIT to use a 401k.
UBIT, not UBIT. Sorry.
No, it's okay. So would a strategy to avoid UBIT be to use a 401k and then convert it to a self-directed Roth?
Well, you don't have to convert it. So the 401k, if you have it with us, it is self-directed. So it's a self-directed, we call it a solo 401k. It's actually one of the best tools that you can self-direct because it's a little bit different than the IRA. The IRAs, we call them self-directed IRAs, but all the investments really have to work through us, or you have to tell us to set up some sort of LLC to invest in. With a solo 401k, you set that up with us, you actually get checkbook control with a 401k because your 401k has a bank account. We help establish that for you, and that bank account is going to have your 401k dollars in it. Now, a lot of people transfer their IRAs or roll their old 401ks into a solo 401k. Again, it's self-directed because you get to pick the investment, but you don't have to convert it to a self-directed account. The solo 401k is self-directed, and in some regards, it's actually easier to self-direct a 401k than it is to self-direct an IRA.
Thank you. Next question. What do you recommend for asset protection when purchasing real estate with a self-directed IRA? Would an LLC slash IRA for each property achieve that, or is that overkill?
I would say it just depends. I'm not at liberty to tell you. I mean, obviously, there's a lot of questions you want to ask, like what state are you working on? What are the laws like? I'll just say this. There is a misconception that you need to have an LLC for asset protection. And I'll just make this point. Your IRA, if you're worried about asset protection, a lot of times if I'm investing personally, we're not talking IRAs. If I'm investing personally, I'm always going to set up an LLC for my real estate investments because if I have a slip and fall on an investment, I don't want to be sued personally. Now, when you're talking about your IRA, remember who owns the property when your IRA owns it? Do you own it? No, I don't own the property. So if I'm looking to just isolate myself so that I'm not sued, well, a lot of times your IRA already gives you that added protection because your IRA is a separate person, it is a separate entity. So again, just giving you food for thought. I've had clients not even use LLCs, but they'll open up different IRAs. Okay, because each IRA is by definition a tax exempt trust, and different IRAs don't touch each other. So I've had some clients buy, some properties in one IRA, and then maybe they go out and they buy a property in another state, and they're not too sure, so they just open up a separate IRA just for that property. That's one way to do it. It's probably a lot cheaper than setting up LLCs for each plan. But if you want to take that added asset protection and really want to isolate things, and there are certain states that you may want to do this in, that may make sense to have an LLC. I'll also say the investment type may change that too. I've had clients that aren't investing in single family, but they're investing in commercial property. Well, the different asset class might force your hand on that, where an attorney's going to say, no, 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 we're not owning a commercial property with the IRA as the owner. We're setting up a LLC or some sort of corporate entity where the IRA is going to own that entity, and the entity will own the business. So it just comes back to depends. The point I just want to make is that you don't need it. It's just an option. So weigh out your option. What are the risks that you're trying to avoid? Remember that your IRAs do have their own house of protection. You can open up you can have as many IRAs as you want, by the way. You're not limited on how many IRAs. So you can use that as asset protection, or you can use LLCs as a little bit of asset protection. I even have clients that use trusts and as not necessarily asset protection, but for anonymity. Again, there's so many different ways you can strategize it. I would just say, just scope out what you're doing, the state that you're doing it in, the asset type you're doing it with, consult with an attorney and go from there. But you're not required to have an LLC by no means.
All right. Regarding non-recourse lenders slash funding, do you recommend any that will fund a mortgage note portfolio for asset purchases? And if so, how would this be taxed on a self-directed IRA slash LLC?
So I'm not quite sure on funding a mortgage note portfolio. I mean, you can sure ask. I mean, I don't really recommend anybody, but what I would say is reach out to maybe Titan Bank. Titan Bank works with a lot of our clients. They do offer non-recourse loans on real estate, like rental property. Most of the non-recourse lenders stick to income producing rental property. So single family, small multifamily, not really commercial, maybe some. When you start getting outside of the box on there, I would always say I've had some clients have some success with small community banks if they have a relationship with a small community bank. Sometimes community banks, if they love your business, they'll just create a product for you. I've seen that actually happen. I had a client buying land with his self-directed IRA, and he couldn't find any non-recourse lenders that would loan on land, but his credit union did. So not saying that that's going to be the case for this, but maybe reach out to Titan Bank, ask them. They might not do it, but they might have somebody that does. So I would start there. So,
All right. And then our last question in the queue says, if you have an S corp with a W-2 for yourself, can you contribute to personal plans like a traditional IRA or Roth and a solo 401k?
yes, you can. So I remember IRAs, traditional Roth, all you need is earned income. Okay, it can be wages, it can be salaries, it can be commissions, Schedule C. It just can't be Social Security or disability. Okay, but if you do have that self-employment income, you also have the option to also contribute to the employer plan. So you get like an added, it's like an extra page on the menu for you. Anybody with earned income can contribute to a traditional Roth. Self-employed individuals can contribute to the employer plans. And really just about anybody, provided you have the right health insurance and you've got kids, can make contributions to HSAs and ESAs. So I would just go back to that slideshow. If you want a copy of the presentation, just shoot me an email. I'll send it to you. I know we went a little bit over, but it seemed like most of the people stuck on, so I don't mind. I hope this was helpful to you guys. We are going to do another workshop, so I would encourage you guys to schedule or register for our next workshop as well, which is going to be in 2 weeks. I have a good friend of mine, Jason Bible, called Mr. Texas Real Estate. He's done thousands and thousands of real estate transactions. He's a wealth of knowledge. I'm going to have him on as a guest in 2 weeks. He's going to talk about real estate exit strategies. He's done pretty much everything there is, and I'm not promoting him. I'm just saying I just know from his line of work he's done a lot of different types of real estate transactions, and he's always really good about talking about why he chose this exit strategy over that exit strategy. And again, all those decisions can apply to a retirement plan if you're intending to buy real estate in your self-directed retirement plan. So I hope that yes, and yes, Lisa, this is recorded. We also will send, we're going to send out a follow-up email probably in the next day or two. Once we get this uploaded to YouTube, we'll send you a copy of the recording so you can rewatch it. And I thank you guys for joining us. Again, I know it went over, but we still got over 50 people on there. So great. Make sure you register for the next workshop. Make sure you schedule a call with me and make sure you guys at least get your started. Open up an account. That's the first step. You don't have to put money in it. We have no account minimums, but at least get those accounts established. It's 2024. Let's start off the year right and rock and roll. So thank you guys. Have a great rest of your week. I'll talk to you soon.